So just to start, what do you think about pressure on equity valuations at the levels that they are on right now?
Yeah, the way I look at the world, the market cycle has different phases, and where we have been for the last few years has really been the Goldilocks sort of mid-cycle phase. Decent growth, double-digit earnings growth, but no inflation, low interest rates, a Fed that's sort of not getting in the way of things. And I think now we're transitioning towards what we call late cycle. We're not there yet, but we're clearly moving in that direction. So the Fed is now in play, it's raising rates. And typically that's the part of the market cycle where valuations start to come down. And I think that's especially relevant today because valuations have been so high. As of January, at the recent high, the trailing PE was at 21 times earnings, which really gets up there. And so I think for the next year or so, as we approach and enter late cycle, that's really going to be the big part of the conversation.
And how much do earnings have to continue to grow in order to offset compression that we're seeing in valuations?
Yeah, so that's really the critical element, because when you look at the market's history, if PEs need to come down, more often than not, that means the market comes down as well. But about a quarter of the time, you can have a PE reset, if you will, while the market generally stays up. And I know the market's down 10%, but statistically speaking, that's not a big deal historically. So the key component to that is how strong earnings growth is, because when you look at valuation, it's really the earnings go in the numerator of the discounted cash flow model, and the interest rate or the liquidity environment goes in the denominator. And the stronger that earnings growth is in the numerator, the more the PE can reset lower without knocking the market down. And that's basically what we're seeing. The forward PE using next 12-month expected earnings has already declined from 19.4 in January to 16.1 at the recent low a few days ago. That's a really constructive thing to happen while the market really is down 8 or 10%.
So not at the same scale.
Exactly.
And what are you looking at during this earnings cycle to see if we will continue to be in that period where, like you say, we're threading the needle in that sweet spot?
Yeah, so it's interesting because generally the earnings estimates, if you look at the aggregated consensus numbers, they tend to start high and drift lower. I mean, that's sort of been a hallmark of earnings season. But this time around, this will be the first quarter since the corporate tax cut. And the estimate is for 17% year-over-year growth. And that estimate has been rock solid now for probably at least 4 or 5 weeks. So it's really interesting how it has not drifted down. And the same thing is true for Q2, which is pegged at 19% right now. So what I'm looking at for earnings season, which of course is starting now, is to see whether the companies will deliver that 17%. And my guess is that they are, because generally, if they're not going to, they will guide lower. Nobody likes surprises. But more importantly, will they guide towards the next quarter lower, the same, or higher? And again, the tax cuts were really a monumental event, a one-time event that a lot of companies weren't even really expecting. And this will be the first quarter post that tax cut. So it will be an important barometer to see where companies think they're going, not so much in Q1, but moving forward. And if earnings growth stays up, in the 17, 19, 20%, you can have what I would call a benign valuation reset. But if the numbers turn out to be either too high or they're where they need to be, but they will come down, then that maybe is a different story, because then you lose that tailwind.
And when you look at the tech sector, is the same hold true as far as valuation pressures?
For the tech sector, I think it's really about the earnings growth, because on a forward PE basis, the tech sector only trades at 18 times earnings, and the market trades at 16, 17 times. So it's really not that expensive. Price to sales is, I think, at 4 times. Back in 2000 at the dot-com peak, it was 7 times. So, so I don't think it's necessarily a valuation problem, but obviously it's been a big momentum play. They have the earnings growth, and I think as long as that earnings growth continues, I think that sector will be okay. The whole kind of growth, structural growth area will be okay. But I think it comes down to the earnings. When you have very high earnings growth, you can support higher valuations, but even then we don't really have such high valuations in tech.
And one of the other valuation pressures that you talk about are the fears of a trade war or anti-trade policies. Can you talk about that?
Yeah, so if globalization which of course we've had since the early 90s, but especially in the 2000s, if the byproduct of globalization is stronger global growth and lower inflation, then protectionism, I think, is a form of deglobalization, should bring the opposite. So it'll bring less growth, still positive growth, but just more moderate growth, and probably somewhat higher inflation. And again, inflation and PE ratios are very closely inversely correlated over time. And so if inflation goes up, the PE should come down. So it's another hallmark of late cycle. You got the Fed, you've got tariffs, potentially protectionist trade policy, and both of those don't necessarily have to knock the market down, but they are PE negatives. They're headwinds for PEs, and then it comes back to threading that needle of earnings offsetting the overall pressure on PEs.
And the Fed tightening being PE negative, how worried are you about that, and how could it get to a place that becomes more dangerous for the market?
Yeah. So last August, which was a key inflection point for the market, because at that point nobody was expecting tax cuts anymore, and the 10-year Treasury had fallen to 2%, and the bond market, which of course is always pricing in the potential future, was pricing in only one more rate hike over the subsequent 2 years, which was kind of silly because the Fed, through its dots, was signaling 6 rate hikes in 2 years. So the market and the Fed were completely on different pages. Now they're much closer. You know, as the market reset because the tax cuts happened, the bond market and the Fed started to think about, okay, we're getting fiscal stimulus 9 years into an expansion at full employment. That has to be inflationary. So now the market is pricing in about 4 more hikes in 2 years. The Fed is at 5. So they're still not on the same page, but they're a lot closer. And so whether the 10-year Treasury belongs at 2.7 or 3.1, it's close enough at this point. So for me to get worried about the Fed is if the Fed ends up being much more hawkish than what the market is expecting, driving that sort of risk-free rate higher, then that would be another headwind. But at this point, there's really no indications for that. And one way that I try to look at it, which is a little geeky, but when you look at the real Fed funds rate and you compare it to what's called the natural rate of interest, R star as it's called, the real funds rate is around 0, and the natural rate is around 0. And historically, the Fed has gotten the economy into trouble when the Fed was about 2 to 3 percentage points above R star. And we're right on top of each other right now. So for me, even if the Fed were to tighten every quarter for the next 2 years, we still kind of don't get to that point where you really get worried about an inverted yield curve and the Fed kind of taking the punch bowl away too much. So I think for now, we're okay here.
And how should investors be positioning themselves in this kind of we're okay and valuations could compress, but are you expecting any big downturns, or are you just a little cautious with more volatility?
The last 2 years until the January high were really extraordinary times for the market, and I fear that investors got spoiled by that because the S&P was up, I think, 52% in 2 years. And in 2017, the volatility, the standard deviation of those returns, was at an all-time low of 3.9. And that created a Sharpe ratio, risk return divided by vol, of 5.5, which is at the 99th percentile of all time, of the entire history. So it literally doesn't get any better than that, and it's not the way the market is normally supposed to be. You're supposed to get 10% a year against a 15 vol, not 25 a year against a 4 vol. So I think as we transition from mid to late, volatility, of course, it already has returned, but it will become a more volatile market, not unusually so, but consistent with history. And returns will be less, still positive, but less. So it's kind of a lower your expectations mindset, but it's still a market that I want to be involved with because, but it's not a time to bet big. Late cycle is a notoriously difficult part of the cycle to pin down, whereas mid-cycle is really the sweet spot. And so you kind of rein in your bets, you lower your expectations, but it's by no means, in my opinion, a reason to get out.